Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I'm going to do some talking about technical analysis and what I look for in charts. And I'm going to talk about a whole bunch of different things here. So this is more of a technical analysis explanation of what I look for in the charts and what convinces me or kind of what I've seen from a technical analysis based standpoint of things patterns that I see, things that I do, where I would be buying, from a seasoned type approach. Not saying that I'm like the best, most seasoned person ever, but I can just kind of tell you what I look for and things that I've noticed. So we'll dive in here. I'll give you my opinion. Again, guys, this is just my financial opinion, what I've seen over the past 18 years of trading this stuff. I would say over the past couple of years, I've taken it a lot more serious than what I did before. So I was kind of just bouncing in and out. Now I'm going to start putting big figures together. What that means is I'm getting a lot more serious. I'm taking a lot more focused approach, and I'm using everything I've learned. And this channel has obviously helped develop me as well, to become a better trader, to become a better person speaking, interacting with you guys. And you guys ask a lot of really good questions in the comment section. And sometimes I may not know the answer 100%, but it makes me think about it for a little while and piece things together. So it's this gigantic jigsaw puzzle that I continue to piece together and lay down a more solid foundation for investing today, in the future, and so forth. But I'd say the majority of it was put together in 2019. So that's not technical analysis wise, just how I look at everything, the whole paradigm, and linking in the housing market. The housing market linking in like changed my entire. It changed everything because it gives me the confidence to hold through a lot of stuff. But I'm gonna show you some stuff about technical analysis and just kind of talk in general, because I flip through a lot of different companies on the daily updates, and this is more about the explanation behind a lot of stuff and how I view things. So I've got a chart pulled up. This is the Sprott Physical Uranium Trust, and I'm going to start marking these things up quite a bit in a lot of this stuff. So we've got this pattern, and what you see in a lot of these charts is we see patterns. We can see, and there's a ton of different patterns. The patterns aren't what is important. It's the understanding behind the patterns that is important. And what you're looking for, and what it seems like for most, I just say the interaction of humans and how they interact with each other, because we're looking at human interaction, and the patterns are being formed by the interaction of we'll call it the herd mentality behind all this. And there's certain patterns that always repeat over time. And I'm going to show you some of these patterns, but you need to understand what's behind the patterns, not necessarily that you can recognize a pattern. A pattern in itself doesn't mean anything. If you understand what's driving the patterns, that's where all the value is. And you can look for, we'll call it ugly patterns that aren't great, but they still work. And that's really what matters, is that they work. So what you're going to see, and this is nothing more than, in my opinion, and this is just my opinion, I have not read a book on this. It has nothing to do. This is just me observing things and using, we'll call it my logic, putting it behind it. And more or less, this is kind of what it deals with. Momentum is a huge deal. Coming to buying and selling points where buyers are starting to equal the sellers. And we hit these resistance lines where things break. So think of it as people hitting psychological levels where they sell things or they buy things. And they create these levels. And other charts are signaling that buyers are starting to equal each other in terms of momentum velocity. So if you have a big move that goes up, it means you have a large imbalance of buyers and sellers. If you have a large move that goes down, you have a large imbalance between sellers and buyers. When they contract, when they come to points, That's where the buyers are starting to equal the sellers. It means that something is being exhausted. So when you look at patterns, it's not the pattern that matters, it's the humans behind it. And it's the interaction of the buyers and the sellers interacting with each other over time. And what we're looking for are exhaustion points. We're looking for where the sellers get exhausted, where the buyers get exhausted, and we're looking for clues when new money's coming into a sector. So the way that these things move isn't because of a chart pattern, it's moving because of the people behind it, behind the pattern. It's the fundamentals and the technicals marrying together and human psychology. So when I look at this pattern behind me, and I'm going to describe it in those types of terms, what we see is a large move up. There was a large imbalance between the buyers and the sellers, and this could very well be new money coming into the sector. Then we see a move lower. It's a smaller move lower, which means that this imbalance happened and people who are chasing price, FOMO, and all this other stuff usually exit the market. And you're left with those with strongest hands at the bottom here. You hit another point and you come on up, but it's not as big on this upward move. So the move isn't as big to the upside, which means that the buyers have exhausted a little bit and that you're starting to come to an equilibrium point. And eventually what happens is you go back and forth where the buyers start to equal the sellers. And it gets smaller and smaller and smaller. So when you look at the right-hand side here, you have what I consider to be a period where the buyers start to equal the sellers, and we're waiting for the sellers to basically exhaust themselves out of this stock. And the exhaustion point came here where we broke to the upside, and we're hanging out a little bit here. But it broke to the upside, and it's signaling that the psychological threshold of this pattern or group of individuals and herd is broken. And that most likely eventually we're going to restart this new money coming into the system, most likely, which will blow to the upside. So the pattern is, think of it as a group of people interacting with each other during this time frame of August here of 21 all the way till January of 2022. This right here, this entire area is considered a consolidation period. So this was a move higher, which is an impulse move higher, and everything after this point here is a consolidation period. And we are about to enter another, in my opinion, move to the upside where we're going to have an impulse move higher because the sellers are exhausted out of this setup. They have exhausted themselves. And we can see it in the pattern of the tightening where the buyers started to equal the sellers, and then you run out of sellers or buyers. If you run out of buyers, this breaks to the downside. If you run out of sellers, it breaks to the upside. So what we did is we ran out of sellers and we're breaking to the upside. Another thing that you want to look at in these patterns is they usually form 3 humps in a consolidation. Hump 1 is this guy. Hump 2 is that guy here. And hump 3 is this little guy at the back. And then sometimes they break right off after, sometimes they dibble-dally around the back end, and then they break to the upside. When you break to the upside on this right-hand side over here, usually when you have a break, sometimes they lag or they do a retest. They break up, and then they come back and do a retest, and then they take off. That is a very likely chance of pattern breaks is they break out, they do a retest, and then they take off. This is a low risk area to be buying, in my opinion, because it's broken to the upside. So that is something I look for in these charts, is I look for the exhaustion of buyers or sellers. I look at how they're interacting with each other, and I look at the pattern it's created. I look to see if it's created the three humps, it consolidates to a point, and did we break to the upside or the downside? And sometimes that can be difficult depending on how you draw it and how messy these things can, how messy the chart is. Revert back to your ratios and your values, revert back to market conditions, and look at these things from a paradigm that if we're in the right market conditions for these to be successful, I would be expecting these to break to the upside. Look at oil, look at other sectors around these to see what they're doing. Because if they're all breaking to the upside, more than likely, uranium's going to break to the upside. So I'm looking at everything, the big picture view. And when these things break to the upside, you want to look at the overall market to see if they're weakening. Because if you have an increasing interest rate environment, usually some stocks like the technology sector is going to weaken. That's going to be the money that fuels this. That's the money that will fuel the commodity sector to go higher. So I'm looking for the fuel to come from technology sector. And remember, these things could get linked where they drop initially and then commodities take off while technology still pummels. So I'm looking for these attributes and links to see how they're all interacting with each other. So those are some of the things that I really focus on for investing here. Now I'm going to go over a couple other charts because this is just one little example here. There's a whole bunch of things that you can look at when you're looking for advantages in the market in terms of technical analysis. And what I look for in bottoms for commodities, and I went over another clip on this, is if the ratios are good and the sector's good, what I look for next is a downward movement, a sideways movement, and then what's going to come is an upward movement, most likely. And there was a couple of things in this chart that I'm going to specifically show you where when looking at it, I would have become ultra bullish had I been looking at it back in 2015. There's a step change where I drew my line. And what I'm going to show you here is the interaction between the buyers and sellers are different on the left-hand side of that line versus the right-hand side of this line. And it's not even, this has nothing to do, you don't have to read a book for this, guys. You don't have to do any of that stuff. All you have to do is look at the chart and think of it as an IQ test. And you look for changes in behaviors. You're looking for changes in the behavior of the pattern or the behavior of the momentum or the behavior of anything. So you can turn this into just a game. It's like an IQ test game. Like you're looking for patterns, you're recognizing patterns. Now, when people think of patterns, they think of like an easy to draw pattern. That's not what I'm talking about here. And I'm going to try to describe my best of what I'm looking at here. When you look at the left-hand side here, look at the size of the red candlesticks in relationship to the green candlesticks. Big down day here. Big down day here. Big down days here. See that? And then look at the up days. They're all small in size coming up. And what you're seeing are the big impulse moves down. The big sellers are getting out of it, and there's not many buyers to hold this thing up, and then it gets sold off again. Now, we've got this momentum from the stock coming down. It's coming down, coming down, coming down, coming down, coming down. That's the momentum it has behind it. This momentum needs to get worked off. The selling pressure far exceeds the buying pressure. So when I look, we have to somehow get this to turn flat. It's called squaring up the move. And we need to see the buyers step in and create large buying pressure candlesticks where the buyers start to equal the sellers and the size of the buying candlesticks start to equal the size of the selling candlesticks. And that's what I look for, is that balance needs to be restored. And what you look at from this line that I've drawn on the right-hand side is you're seeing large candlestick buying pressure and small selling candlestick pressure. And remember, this is on a monthly candlestick basis. It works on any time frame. And the big long-term picture views that I have pulled up here are the fundamentals driving this stock. We're looking at the technical analysis here, but it's the fundamentals that we're actually looking at. And you have to tie this together. It's the way that humans are interacting with each other that is creating this. So the fundamentals are seen in this chart, and it's creating this downward sideways up movement. And what we see on the right-hand side here is the buying pressure is stronger than the selling pressure all through here, which means that we are about to turn. And it took some years for it to turn because it had so much momentum down here. It took a few years for this to flatten it out. So when looking at this, you can tell that this thing is about to turn as it had the momentum down, the momentum went sideways. We were contracting in its lows and highs into a point where the buyers and sellers were coming to a decision point, and the sellers were exhausting themselves. The volume down here stepped in to buy in mass on the right-hand side here. So the volume stepping up also said that new money was coming into the sector and buying it. So the sellers were exhausting themselves. We saw the momentum change from a downtrend to a flat. And then we saw in the candlestick patterns that the pattern was changing in a favorable direction for the buyers because we saw more buying candlestick pressure than the sellers. We saw the pattern coming to a tip. It was coming to a tip because the sellers were exhausting themselves. And we saw volume kicking up, which means new money was coming into the system. Where do you think it's going to go? It's going to go higher after I describe that story. So what I'm using in all of my calculations here, or I should say in the technical analysis, is I'm using the ratios as my cover for my valuations. I'm using the real estate market as my market conditions changing from a unfavorable to favorable environment for commodities. And I'm verifying all of that is happening with the technicals in this chart. Where did I learn this stuff? I didn't learn it from anything. I didn't read hardly anything. So what I did is I looked at some other people, I looked at some of their charts, I looked at other people's charts. I did one training technical analysis course, which laid down the foundation. I pieced together everything else. They didn't teach me this, the candlestick patterns. I just noticed that on my own. I noticed and attributed everything I described in these charts all on my own. I didn't actually read this in a book. I came up with the correlation of the buyers exhausting themselves with how they interact. It was all drawn my own conclusions. So it's not like I read a book on this, and this is how I would describe it to people because that's how I view this. So this is my viewpoint. I didn't get it from anywhere. I didn't read this from a book. This is me coming up with it myself. And with the ratios, and I also came up with that myself too, to some extent. It was already there with the gold and silver type stuff, but I applied it to everything. And I knew other people were doing that. I have read some stuff. I did read things across the sector on a lot of this stuff. So it's not like I came up with this all myself, but I did take bits and pieces and piece it all together. So that's what you see in this type of pattern in Bannerman, and that's how I view this pattern. You can see that the buying pressure is far greater than the selling pressure in these candlesticks. There is nothing in this chart signaling that this is going to turn and go lower on a long-term perspective, at least at this moment. And I'll pull up another pattern here. This is SM Energy. We'll pull that one up because that was one that I really, really liked in the beginning here. So here's SM Energy. And what we saw here is the same type of pattern scenario. I'm going to put on a daily candlestick basis and then back out. So if you were to look, and let me go on the 5-year, you can see it easier on a weekly candlestick basis. So you can see the same type of pattern. This thing hit this guy here. It was coming on down, and we lost control here. This is ridiculous. The ratio said that we should be buying oil at this time. We just needed to see this momentum slow and turn. And what happened was this is a ton of momentum coming to the downside here. It's very steep too. And what it did is we came down, we popped higher, and then we came back because that momentum had to get worked off. There's too many sellers in here. The buyers stepped in and bought this up, and then there's so many sellers, it still overwhelmed it and brought it back down. That's what this pattern is. It was a pattern like this to work off the momentum. I saw it in here and said, there's your opportunity. Buy the living poop out of it. And that's what we did. And when you look at the pattern, you could see big buying pressure on this side of the pattern here, the big candlesticks going up, and then you see small candlesticks coming back down. This is a leak off of buyers, and then you saw a dead period right here for about a month. And this dead period is where you want to buy. You want to buy when the volatility is the least. You don't want to buy when the volatility is the most. You want to buy it when it's calm. And then you're going to see an explosion of buyers step in, fresh money, and reposition themselves. So one thing I want you to learn here is the ratios tell you where the money is and where it isn't. That is what the ratio is telling you. And again, I didn't read this in a book. This is just me figuring it out. Because if an asset is cheap, it means the money can't be there. You can't have all these expensive assets and have this cheap asset. You can't have everything be expensive all at the same time. You're going to have, if money flows into the system, they're going to go into certain areas based off of market conditions of where the investors prefer. It's just human psychology. And then it blows this sector up, and this one remains low because the money either didn't flow in here or it flowed out of this sector into this sector, creating that ratio imbalance. And what I'm looking for are the ones that are down, that are cheap. And the reason you're looking for the ones that are cheap is because the money isn't in it. And the way that you make money is money has to flow back into it. So investing is nothing more than identifying cheap assets where money has flown out and then identifying when that money will flow back into it. That is all investing is. It's that simple. So you want to identify where the money is not. You focus on those sectors. You look at history to see which ones have the most leverage to the move. You take your technical analysis. You look at those sectors and you say which ones look the best. And you can do fractals. You can do all sorts of stuff to measure projected moves off of the first wave that happens. You buy it on the bottom of that correction phase after the first wave, and then you ride it higher. That's what I did with the majority of these companies. And when I say waves, it's called Elliott wave theory. So I'm integrating Elliott wave theory in with it. So I've got a fundamental valuation background tied in with market balances, market deficits of projected deficits in the future, which tie into the supply-demand curves. And then I tie technical analysis, Elliott wave, and all this other stuff that I've come up with my own and tie it all together. And that's how I invest and try to find these bottoms, is tying it all together. So if you have the market conditions right, you have the valuations right, and you have the technicals right, that's your least risk, best entry point that you could ever have, is at that point. Because the money's not there, which means you don't have many sellers left. And the money, you're just waiting for the money to come back and rotate back into it. So when I look at these and I look at the opportunities here, I think that oil and natural gas are incredible opportunities because we've got these very, very unique, dynamic, weird market balances that are forming in the markets. And the conditions of the markets are different. And I'm not saying the underlying market conditions in terms of expansion phase of real estate or anything like that. What I'm saying is the money has flown out of oil from ESG purposes. The money isn't coming back as quickly as some people would like. It is creating a demand-supply imbalance, which may not be fixable in the short term. The prices could go drastically higher of oil and natural gas because of the underinvestment in oil and natural gas, creating this large imbalance. It's also creating a valuation in some of these companies which are ridiculously cheap that we've never seen before. So we've got valuations that were cheap. We have market conditions that are weird. We've got money that isn't in the sector that's flowing out to create these large imbalances, and they're still not investing in it. And it's the number one premium fuel that is used around the world for growing economies, for the survival of humans. It's the most important commodity, the number one commodity in the world for the survival of humankind. If it's the number one and that we're still using this stuff, it's also the premium fuel in terms of energy return on investment. I'm tying my engineering background into this too, in science. What that means is that we have to use this in order to survive, because the energy returns are greater than anything that we've developed so far. It's also a fuel which we have no replacement for at this moment. You may think that we have replacements of batteries and whatnot. We have not seen a battery economy be sustained based off of the energy returns of batteries. And I don't know if that is sustainable to use batteries and renewables, because no one has done a full analysis. And some people have, where I'll take that back. Some people have done full analysis where the energy returns are not favorable for the survival of humans to use solar and wind only, and the storage systems and all of the materials and minerals that were taken out of the ground with energy that was subsidized by fossil fuels, to actually see this be a positive for humans and the ability for humans to survive off of renewable energy. So the weird dynamics here is that, in my bet, and which is similar to other people's bets, is I went big into oil and uranium, which are proven, known high energy return on investments that will support human life, and bet in those which also had massive returns in other bull markets in terms of leverage. I am betting that the renewables are not a solution, basically. And if I'm right, it's going to be so profitable because the money's not there. I took a counter opinion or a counter approach to everyone else. And if I'm right, that money has to rotate back in for the survival of humans. So, and with that money coming back in, it's going to blow the price of everything up, because we could see that the money was not there from the ratios. We can see that the technical chart patterns, people were buying it at the bottoms, like me. So when you look at this and you tie it all together, you could see one of the largest opportunities for oil. And the reason I say that is, if it's been underinvested and demand goes up and supply goes down, and we get this huge gap that we've never seen in history before, where the demand exceeds the pumping capacity, we could see some crazy stuff happen. And there's no alternative to oil. You can't just fill something up in your tank, or you can't just put diesel in a truck to bring food across the nation. There's a lot of these things that they're not easily replaceable yet. And I don't know if we have replacements. And if you look at it from an engineering perspective, everything relies on energy return on investment, everything. And the higher an energy return on investment, the more energy you have in society to do work. If that declines, it means that your economy has to shrink. And it's going to have negative ramifications. So when looking at some of these things, I don't know if people understand all that. And that's why I'm taking the bet in oil so big, and uranium and these other ones, because those are viable options that have good energy return on investments for sustaining life on any planet there is. And there's a lot of risks for, we'll call it the renewable plan A, that governments are relying on that may not work out in terms of shortages of materials, and it's a vast array. And if oil gets too expensive, it's just going to blow up the cost of those renewables as well. So it's I don't know if the renewables in their current form are good enough substitutes to substitute oil, natural gas, coal because of energy return in its entirety, of the entire supply chain of those, and the entire design of those systems. And the entire design is all the minerals, the energy to get the minerals, the energy to put the minerals together, can form them into a configuration where it's producing electricity, and how much electricity and energy was used to put this together, to mine it, to refine it, and do all that stuff, and how much energy are you getting back? Because if it takes more energy that you to put in than you're getting back, it's a net energy sink. Hydrogen is an energy carrier. It's not an energy producer. So that is just more or less a battery, hydrogen. So we're not getting any energy from hydrogen. That's just a storer. So it has to come from something that generates power. And humans, looking at history, have only gathered energy. We've never actually created it or produced it. We've only gathered it from society, or I should say not from society, but gathered it from our earth or wherever. So that is my bet, is I'm betting big on energy. And I do have metals, and metals is more or less just an energy bet anyway, because I'm buying metals that are used in society that have great utility, like silver and platinum, that are very hard to extract and use a lot of energy to get. So if I own it in my hand outright, I used a low energy environment to obtain it. And if energy becomes more expensive or more scarce, then it's harder to get these metals. So really, it's a play on energy. So all my plays are basically based off of an energy paradigm, so to speak. But that's some of the stuff in technical analysis that I use to look for these things. And I know that went into some other stuff at the end there, but that's what I look for. And here, I'll do one last thing here, because I do like the way this chart looks. And sometimes it doesn't pan out that way, guys, but this chart here looks absolutely beautiful. And the reason being is you've got massive moves from 12 cents to $11. We see this massive move higher. We've got buying pressure of these big candlesticks all through here, with small pullbacks coming in. This is another small pullback into a bullish engulfing pattern. This is another pattern that broke to the upside. So this thing, if you look, it went into a bullish engulfing pattern here. This big bullet, the big buying pressure and small selling pressure. This thing, if you notice, it's slanted downward. It's less slanted downward. It's flattening out. And where do you think this is going to go? It's going to go higher. So I've loaded into recaf because the pattern. Notice the big buying pressure and the small sell-off here. And I'm not telling anyone to buy this stuff, guys. I'm just showing you what I look for in a chart pattern. But I can't see a single, in my opinion, I can't see a single bearish trait in a recaf in its chart, because I just haven't seen it. It's all big buying pressure, small selling pressure. And it's coming to a point where the sellers have leaked out and the buyers are going to come in. And all we need is new money to step in here, and this thing's going to go vertical. And we've got the fractals behind it too. It's got big moves. So if they have what they have, if they're not lying, and some people are saying that they were falsifying some stuff and the short sellers got squeezed like no other. And I'm sure it's the short sellers that are probably trying to sue them. They're going to get squeezed again. They're going to get squeezed bad. At least that's what the chart tells me. But that's the way you chart. And remember, this stuff isn't 100%, guys. This is only probabilities. That's all we have to work with. So I'll leave you with recap. That's the one that looks really good right now, in my opinion. And it's right there at that point where we could break to the upside dramatically. But again, it's just statistical probabilities. Doesn't mean it's 100%. That's why we limit our position sizes. We can put stop losses if you want right below it. If I were to do that on this, the way that I would set it up would be I would probably put a stop loss kind of maybe at 435 down here and then try to ride it up. The projected move out of this is 10 bucks. Downside risk, you could put a couple cents, 30, 40 cents or something like that. So that's kind of how I would do it. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.